Hey everyone, it's Randy McDonald from Realty Connect. I'm here with mortgage broker David Grossman here in Toronto. David's been a mortgage broker for about 15 years, and so we're here to talk about construction financing for real estate developments, the current state of the lending market for that, and where things are at with the stress test, and private lending versus bank lending, and so forth. So
good to be here, Randy.
Okay,
thanks for having me.
Thanks for coming. So David, how is construction financing different at a concept level than other types of developer financing?
Well, quite simply, construction financing is financing that is advanced in stages. So you do a little bit of work to your project, to your build, and once some work's done, the appraiser goes in, he takes a look, see how much work was done, and then he releases money. So that's the key difference of construction financing compared to regular financing.
Right. So as you get parts of the project done, you get more. That way it keeps the developer accountable and so forth.
It keeps the developer accountable, and the other part of it is that with construction financing, you only pay interest on the money that's advanced. So you don't necessarily need $500,000 up front if all you need, let's say, over the next 4 weeks is maybe 100 or 150,000. So it keeps your costs down. And the final thing I'll say about construction financing is that the lenders are aware of what you're doing, so they're not going to lock you into a long-term mortgage. So when your project and your build is finally complete, you can sell it or refinance and pay out the construction lender without any penalty. So that's an important part of it as well.
Okay, so let's talk a bit about the stress test. So I just read a report from CMHC that said 2018 was the slowest year for mortgages in 25 years. It was even slower than the 2008 so-called Great Recession. So how do you see the stress test impacting construction financing and developers?
Well, I mean, I think the biggest way that the stress test has impacted developers and builders is that your end product, if you're trying to sell it to a regular consumer, and they're being shy about buying properties either because they don't qualify like they may have in the past, or maybe they're scared to buy, then it's harder to sell your end product. But generally speaking, banks are tough and they're strict. So this is just another example, the stress test, of how banks are hard to deal with, hard to get the money that you need to do whatever it is you want to do, whether it's construction financing or not. It's just another example of how banks are tight when it comes to lending money and why people need to often seek out alternatives.
Right, okay. So today, considering the stress test and where we were at in 2019, for construction financing, how does private lending compare to bank lending?
Okay, well, I mean, the biggest difference, I guess there's a few differences. So the first thing is that banks are very strict. They're going to turn you upside down. They're going to want to see your tax returns. How much money do you have in a deal? How much have you put into the deal? How much did you make this year? What does your credit look like? What is the name, age, and address of your firstborn? They're going to want to know everything, okay? And the reality is that builders, like many people, are self-employed, so their tax returns may not be very indicative of the money that they're earning. Also, when it comes to getting further advances on your construction project, you want somebody who you know is a specialist in this area, who's in it and will make sure that your project gets moved along, because you don't want to get stalled either. So if you want somebody who's going to be flexible and knows what you're doing, then oftentimes you're going to need to seek alternative lending.
Right. So you were talking about earlier to me about how private lenders will view the transaction differently than bank lenders in terms of how much they'll give. So talk about that.
Okay, so that's a good point, Randy. There's the question of how much money can you get, because normally when you're doing anything in business, if you can use other people's money rather than your own money, that's the best thing. So a lot of lenders are going to lend money on construction financing based on your costs and how much you've spent. They're going to want to see your bills. They're going to want to make sure that your you know, that everything is organized to the letter. Sometimes we have lenders who will lend based on the percentage completion of the project. So if you're somebody who has experience, you have access to low-cost materials, should be quality materials still, of course, but let's say you get a good deal and you have access to trades, then what's most important in your project is how far along that you've gotten. So if you're building, let's say a single family home, as an example, is going to be worth $1 million when it's complete, and the appraiser comes in and says, oh, you're 50% complete. The lender that we deal with will often say, okay, fine, we're going to lend you $500,000 on that. Of course, there's the land too, which they will lend on as well, but I'm just giving you an example. So it doesn't necessarily mean what you've spent. This helps people because oftentimes you can progress in your project with little outlay if you have access to discounts, let's say, in your materials and your labor.
Mm-hmm. Okay, so you mentioned earlier about refinancing. Now, refinancing is one of those highly underutilized tools that people have at their disposal for their, for buying a second property, whether it be an investment. And so talk about refinancing because it's tapping into money you already have. So how can a developer do that as well in the current climate with stress tests and so forth?
Okay, so I mean, you raise a good point there, Randy. It's not only, construction financing is one way to get things done, but if people can tap into equity, let's say in their own home, if they're willing to do that, and they can get, let's say, a line of credit on their house, that is likely the lowest cost way to complete your build, because, well, with a line of credit, same as construction financing, you only borrow money when you need it. But if you've got that line of credit set up on your house, you're looking at paying, potentially bank rates, 4%, 4.5%, something to that effect. And it's an alternative. Sometimes people can't get enough money on a particular project to complete it, so they need lenders who are going to be creative and look to see, do you own other properties? Do you have equity in other properties? How can we help you to get your project done quickly? That's one of the most important things, because with construction, you don't have any income coming in on that property. You only have money going out. You have trades sitting around sometimes that you don't want sitting around. You got to keep them going. You want the project finished. And you're only paying interest on money that you borrow. You've got no renters until the project is complete. So you need to be working with people that are going to be creative and help you get your project done quickly.
Great. Okay. Well, thanks, David. Thanks for your insights. So if you'd like to book a consultation with David, click the link below, and I'd be more than happy to talk to you about your various options in terms of bank versus private financing and what's best for you and your project and your overall financial circumstances. So thanks for watching, and we'll see you in the next video.
Thanks, Randy.
Thank you.
Appreciate it.